Good afternoon, ladies and gentlemen, and welcome to the SDI Group PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your questions at any time and press send. Given the attendance on today's call, the company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll, and if you give that your kind attention, I'm sure the company will be most grateful. I'd now like to hand over to Mike Creedon, CEO. Good afternoon.
Good afternoon. So this is the interim presentation for our results to October 2023. So we'll start with the agenda. You can see the group summary, board of directors. I'll go through a bit more detail this time, and followed by the group overview, UK, world and presence, acquisition process, acquisition timeline. Then I'll hand over to Ami, who will go through the H1 FY24 results, and then we'll come to the conclusion with the trading and outlook. It's interesting to the back. We've shown this on a few occasions, the appendices, whereby it gives in more detail our subsidiaries or business units, where we've got 15 of them now, our financial track record, and also our capital structure. So if we move on then, Ami. Okay, that's all right. Right, laptop, okay. So I just wanted to go a bit more detail here. So let's start at the top with Ken. Ken Ford is chairman. He joined in 2010. He recruited me as the CFO in 2010. You got Ken's CV and my CV. You've seen it many times. It was a turnaround by myself as being the only executive director for about 6 years. And during this period, I was supported heavily by Ken. So Ken and I, for the first 5 or 6 years, we spoke nearly every day, including weekends. But as we grew, became a lot more profitable and cash generative, we strengthened the board. So what I introduced were some high-level NEDs, going in recruitment order with David Tilston, Andrew Hosty, and then very recently with Louise Early. Their CVs are included within the pack, but what I'd like to do is spend a few moments handing over to Ami and then to Stephen, the new boy on the block, with their sort of CVs. So over to Ami.
Yeah, hi, I'm Ami Sharma here. I think many of you will have seen me before at previous IMC meetings. My background is I was formerly Group CFO at FTSE 250 listed Ultra Electronics Holdings. I was also their Group Financial Controller during the early 2000s when they embarked on a buy and build, not too dissimilar to SDI. I'm also a non-executive on the board of Corvair PLC, which also follows a similar business model to SDI.
I'm Stephen Brown. I joined the board at the end of September 2023. So I have a technical product and commercial background and bring a strong track record of business growth to the exec team. Previously, I held a number of senior positions with significant tech-focused businesses, most recently including AB Dynamics PLC and BP Launchpad, the business scaling function of BP PLC. My initial focus will be on the organic growth portfolio businesses, in particular profit growth. In parallel, I'll also be working with Mike and Ami to pursue high-quality acquisitions, as well as building a strong deal flow to support this.
Thanks, Stephen and Ami. Let's move on through the pack now. When we look at the group overview, I think this has been shown before, but it'd be good to repeat it. We've got a further acquisition on the slide. So the strength of our business model remains unchanged. It's operating as autonomous business units, but we're seeing synergies within the group as we acquire additional complementary businesses. All acquired businesses, they've got to be profitable and cash generative. We do not look at acquiring blue sky businesses. We don't rely on a single sector or region for trading, which has proven its worth during the sort of 2-year COVID period, where we had a number of businesses who were trading not in line with budget, but still generating profits and cash. And then we had some real sort of powerful businesses who took us through the COVID years. We acquire businesses and invest in organic growth. As we will actually go through the presentation, we'll probably give some examples of that. You can see on the chart, as we started buying the businesses, there was a greater weighting towards sensors and controls. That's due to the acquisitions within this sector. We've added a further business unit, you can see on the end, which is Peak Sensors. We've got a separate slide on that. We'll discuss at length within the pack. So over the years, I think since 2019, John Abel introduced these sectors. What actually happened was that the city wanted more and more financial data about what we actually do. So instead of one group of companies, we split it into two sectors. We didn't want to show all the gross margins of the businesses, which range from 55 up to 80% on material costs only. So therefore, we set these sectors in place. But as you can actually see from the sectors, in 2019, we only turned over 17 million, and we didn't have as many businesses. And now the segment structure hasn't worked as well. It's too imbalanced, as you can actually see from that diagram. So at the year end, and Ami's looking at this at the moment, we intend to reorganise the business sectors, still in two segments, but these segments will be reclassified. So what we're looking at is lab products businesses and the other containing scientific and industrial products businesses. And hopefully this will provide better information to the likes of yourselves. And what we'll actually try to do as well is to show the before and after. So what will show the revenues as is now and as is in the future. So it's still work in progress for us. We've got an idea of what is going to go into the lab group at the moment, and I'll discuss that as we go through the pack. So if we go on to the next page, which is the world presence, and so we've got an additional business on there, as you well know. So what we've actually got is a heavy UK presence in the UK, with a growing presence in the rest of the world as we acquire additional businesses. So what we've got is currently 17 sites in the UK and 4 overseas. So we've got Lisbon, so that's attached to Acid Cameras. That's their manufacturing site. We've had that ever since I've been with the business. And then when we acquired Fast, which is Fraser Anti-Static Techniques, based in Devon, they've got 2 subsidiaries, one in Dresden and one in Shanghai. So again, I think we'll just discuss about China later on. And then the last one, again, it's been there for many years, and that is Synoptics Inc., which is based in Frederick, which is just outside Washington, DC. The latest addition is Peak Sensors, and that's based in Chesterfield. What is the acquisition? Oh, sorry, let's go through the acquisition process. Okay. So we discussed this acquisition process at the presentation recently, and it's also been included within the appendices. But it's nice to actually see this within the pack. So we'll just go through this. We've seen it on a number of occasions. What are the acquisition criteria for the SDI group? It has to be a scientific, technical with a manufacturing arm to it. That's very good for us because then we control the cost of materials, and so it's a has to really for us. They have to be, and I insist on this, profitably cash generative. And we said this earlier on, we don't want cash burn businesses. It's good to have a strong track record within the businesses. It's a lot easier to do financial due diligence when you've got the historical data behind you. They have to have a strong management team because head office is us three, you've seen us, we can't manage these businesses. So when we acquire businesses, we have to make sure, and there's a certain level of trust between us and the subsidiaries we're looking to buy, that we'd like the founders to stay on. If not, then we have to make sure there is succession planning in place for these businesses. We have actually sort of turned down a few businesses whereby people didn't want to stay with the business, and they were saying it's up to us to find succession. Well, we can't handle that at all. We offer businesses at a fair price. So we've been buying businesses at a 3-year historical price at between 3.5 and 5.8 times profit before tax, and then including net assets. So what I like to do, I think this has been in motion for ever since we've been acquiring businesses since 2014, is splitting the goodwill price from the net assets, and that's what. And then it's fully open of what we're buying the goodwill at. And the last point in that section is we like strong exporters within the niche sector. So currently our exports, it's about 50-50, I mean, thereabouts. You know, the biggest problem we've actually got is we do sell to OEMs, so we don't know in a number of circumstances where that product's going out to. Before we started, we were heavily involved in OEMs. It was 60-40, 60 overseas, and 40 in the UK, but it's difficult to get that data now. Why do people want to join SDI? Well, the size of the businesses we're acquiring, it's difficult to find owners to find for the owners to find a suitable buyer. We're looking at businesses making between £500,000 and £1 million. The next point is what we want from the businesses, and that is what the buyers want from the businesses. Is still maintain independence from the businesses. We try to leave them as autonomous business units, and that's imperative because what we want to do is to retain the culture and the brands going forward under the ownership of SDI. What we're trying to now, which is new to us, is sharing knowledge within the group. So we're actually bringing these teams of people together. And this includes the strategy meetings. We have the marketing meetings as well. And also recently, with this lab group, we've been bringing together the directors and the senior managers to try to share data. Marketing was one of the first ones strategy was the first one we introduced, and then we've recently brought marketing together. And marketing is a young kids game today. It's driving people through to the website. There are a lot of tools in driving people through to the website and sharing that data. One of the main areas they're looking at today is, instead of using Google AdWords, there are the pieces of software to drive you through to the website, as well as ChatGPT they're using as well. What we offer there as well is strong financial support within head office. And also what we try to do is to share specialist resources, for example, technical support. And this is another thing, going back to sharing knowledge within the group. After acquisition, what do? Well, we implement strong financial controls. The majority of the businesses are using Sage systems. These days, I think the modern system is Sage 200. Sage 50 is falling away. So we're introducing a couple of the companies onto Sage 200 at the moment. And that seems to be the vehicle going forward for the subsidiaries. But what Amy and Jonathan, the financial controller, are introducing now is a consolidated piece of software. So a few words on that, Amy.
Yeah, we're introducing a new financial consolidation system at the centre, which will enable us to extract data from the subsidiaries more efficiently and also provide scalability as we grow.
Thank you. But also what we look at as well, as I already mentioned about strategy, is strategic plans for the businesses. Businesses, when we acquire them, they're concerned about generating profits and cash, which is good for us. But also, they probably only go out for a year in the way of the budgeting process. So what we're trying to do is to ask them to think about what the next 3, 4, 5 year plans are. So within the strategy meetings we held sort of 4 to 6 weeks ago, probably a bit longer, is that the individual business units will actually do very similar to what we're doing in a way of an investor presentation, not just to the main board, but also the subsidiary directors and senior managers. 20 minutes Q&A, which is really sort of organised by Amy. Presentation, 20 minutes with a Q&A for 20 minutes. And that's spread over sort of a couple of days. And it's worked very well. What people like is, as well as the investor presentations, is sitting around a table for dinner, having a drink afterwards and talking about business. And it's worked very well for us over the last sort of couple of years. So if we move on to the next bit, Amy. Acquisition timeline. Again, this is something which we've had in the pack. It's been in the annual report. So to date, we've bought 18 businesses. The first one being Opus Instruments. That was in 2014, February 2014. And this was funded with bank debt. Very friendly bank manager. And he lent us, Ken and I, all the companies, £700,000 with 300,000 on an earn-out. That was quickly repaid. That business was incorporated into Attic Cameras. And then following that, it was a game changer for SDI. It really put us on the map. And that was, first of all, acquiring Centac, 4 times PBIT, including net assets, followed by Peter Astle's company, which was Astle's Control Systems. These were funded through share placings. The first one, Centac, 8p a share. That was using EIS VT2, so it was very good for the shareholders. Then after tax, we're looking at sort of 6.5p. Followed that by Astle's Control Systems at 13p. Sadly, the EIS VT2 structure changed, so that the shareholders couldn't latch onto that. Then, for a number of years, we acquired businesses using our own internally generated cash and bank debt. which works very well. But sorry, I've lost my train of thought then. And and then in 2019, we acquired 5 businesses, which required funding over and above the board's comfort zone for gearing. So then we did another share placing, and that was at 34p a share. You can actually see on the map, the 5 businesses in a row. And thereafter, we've been using bank debt and our own cash resources. What I was actually going to say when I lost my train of thought is we set up bank debt with HSBC. All the banks were actually interested in us. And that was initially with a 3 million debt with a 2 million accordion. So today that's been extended. So we've got a 25 million debt with a 5 million accordion. I think that's correct, isn't it, Amy? And I'll hand over to Amy. Amy's got a cold, so just bear with him, I'm afraid.
Yes, I'm a bit croaky, so bear with me. Okay, looking at the key financial highlights for the half year, we saw revenues grow over the period by 1.6%. The comparatives include the significant attic cameras contracts for equipment that go into VCR machines. This came to an end last year, as we have previously communicated. Excluding this, there was organic revenue growth of 2.2%. Scientific vacuum services shipped a sputtering machine over the first half, and Attic's significant OEM customer for gel dot cameras destocked over the period. And we will talk about both of these a bit later on. It's also worth noting that the tax rate has increased from 19% to 25%, and this impacts upon all the EPS measures. This is an extract from the income statement. Acquisitions provide £6.3 million of growth, or 20%. At a headline level, there was an 18.4% organic decline, and the net of the two gives the 1.6% absolute growth. Gross margins held at 63%, which was encouraging. We've controlled our cost base when looking at costs on an organic basis and excluding non-operating items or below-the-line items. Costs have increased by 1.5%. Profits have reduced, as we always expected for this financial year. The biggest component of this loss was the loss of the 60% gross margin on the £6.4 million of COVID revenues. And to save you using your calculator, this represents £3.8 million in lower profits. This has been partially, but not completely, offset by acquisitions, and the percentage declines on this slide reflect this reduction. The first half of the year was also impacted profit-wise by the aforementioned destocking by Attic's main OEM customer, and this reduced sales in the first half by £1 million. Monmouth also had a slow first half, which we will talk about later. This shows how revenues have moved compared to the equivalent period last year. As I've mentioned, last year's acquisitions contributed £6.3 million in revenues, and you can see the impact of the reduction in the one-off Attic PCR camera business. It is worth noting that over the last 2 financial years, we have reinvested the Attic camera PCR cash flows into growth for the company, acquiring Safe Lab Systems, SVS, and LTE Scientific. Looking at our segment performances, Sensors and Control revenues increased by 40% to £26.8 million. This includes the £6.3 million of acquisition growth from FAST and LTE Scientific. Excluding this, organic growth was 6.7%. Astles Control Systems and Applied Thermal Controls both had good trading periods. Applied Thermal for its chillers, and Astles had weaker comparatives, which were influenced by component shortages. Scientific Vacuum Services is a lumpy revenue and order business. It shipped a significant piece of equipment to its major OEM customer in the first half, and this supported the organic growth of this segment. This particular OEM customer has rescheduled its future order profile as a result of geopolitical events, and this has changed SVS's revenue profile for the current financial year. Digital imaging revenues reduced by 12%, excluding the COVID comparatives, and the segment's profits reduced to 645k. As I said earlier, there was a £3.8 million profit reduction due to the COVID contract ending, and this falls within this segment. However, Attic's major OEM customer destocked over the first half, reducing sales by £1 million. Deliveries to this customer are continuing, and we have order cover for the next 18 months. But the number of cameras are not currently expected to be at the same volume. The destocking impact will not be recovered in the current financial year. Turning to cash. Working capital increased by £2.3 million over the period. It's mainly due to a £2.7 million reduction in customer advances since the year end. SVS shipped equipment in the first half, and this is responsible for £1.4 million of this. LTE Scientific and Astor Control Systems saw customer advances decline by £1.1 million between them. We now have £2.1 million of customer advances on the balance sheet, compared to £5.3 million a year ago. This is a difficult balance sheet line to forecast, as new customer advances are often dependent on contract milestones and order intake, and more specifically, order intake with a customer advance tied to it. As the cost of money is no longer low, customers are less willing to give upfront payments. Currently, we expect this to reduce further over half two by around 500k. Cash generated by operations was £3.3 million this first half, an improvement on the equivalent period last year. Interest charges have gone up due to our higher debt levels and increased interest rates. Focusing on working capital will be a priority over the second half of the year for us. This slide shows the working capital movements I've spoken about. The tax payments are higher since SDI is paying 25% tax now under the group payment arrangement. And at the end of the period, net debt was largely unchanged from year end at £13.2 million. Some comments on our financing position. £1.25 million of the revolving credit banking facility was paid down over the first half, as we look to reduce excess cash balances. £10.25 million of the facility was unused at the period end, and the £5 million accordion option is still available to us at HSBC's discretion. At the end of the period, the net debt to EBITDA ratio was 1.1 times, comfortably inside the ceiling provided by our bank facility. And at the end of the half year, we had £1 million in deferred consideration payable. This relates to the acquisition of SVS. And this has been paid in full in the last week or so, and so will be paid, obviously, in the second half. That's all from me.
Thank you. So moving on to the next page. That's it, trading. So when we've been going around on city presentations, this is the sort of slide we start with, because they know the history. It's interesting because this is the slide sort of in English to say, why did the downgrade occur? So now we've got 15 business units. 3 of those businesses have found trading difficult and responsible for the downgrade during this period. So I'd like to discuss this in more depth on these 3 business units. So the first one really is Attic Cameras. So the effect to our annualised profits was a reduction of £1 million. It hasn't gone away, it's just gone to the right. So Attic suffered from destocking from its largest customer that impacted the H1 performance. However, we have now received the strong order coverage from this customer, so it will take us through H2 and beyond. So what actually happened with the customer is they moved procurement from Singapore to a centralised place in the Netherlands. They decided to destock, moving from 3 months down to 1 month, and it was dragging out. But pleased to say that we've actually got the order now, and that will take us over 18 months, won't it, Alan? 18 months, but it's too late to affect sort of H1. So we're starting to ship that product in December. Last time it was in October, now it's moved to December because of the movement or the reduction in stock from 3 months to 1 month. We have got the sensors in place, and we're ready to actually start shipping the products. There is another sort of a positive as well. There's a high expectation of another large order from a newly developed product within one of our core sectors, which is the professional astronomer market. So that's what high hopes of getting a significant order from America for that product. The next one we move on to, these are sort of lower level reductions in profits, is scientific vacuum systems, and the effect on annualised profits is £200,000. They shipped a sputtering machine to a razor blade manufacturer in October. I'm afraid it was a bit late. It was delayed by 12 months due to a couple of reasons, really. First of all, component delays, which we're seeing across the world. And secondly, due to the component delays, the customer decided to change the requirements of the machine. So there was further delays. That now is complete. They've inspected the machine in the UK. There was further delays because then they decided their R&D department in Boston in the US wanted to come and see the machine, as they really like the machine. Now it's been shipped out to Mexico, waiting for the next order, because they've actually said there's going to be 4 or 5 orders for these machines. The next order we're actually looking at, but that won't be until it's commissioned, this machine in Mexico, which is due to be commissioned January, February time. So we're expecting the next order probably to come from Poland. We are expecting an order. This was a number of over a year ago from Russia, but of course with the war in Ukraine, that's impacted that shipment. Since we've actually shipped that product, we've had another sizable order. Again, it's all a bit late for the H1 period, and that's for 2.3 million from another customer, and that's due to start next month. As we pointed out when we were acquiring SVS or Scientific Vacuum Systems, their orders and revenues will be lumpy. And AMI, if possible, is trying to recognise the revenues at set periods within the contract under IFRS 15. So it all depends on what's written in the contract. So it's a difficult call for us on that, but at least we've got a substantial order from another customer. The next one we wanted to discuss really was Fraser Anti-Static Technologies, FAST. That again has had a reduction in profits of 200,000. FAST have seen an economic slowdown from 2 its dominant markets, China, but more importantly Germany. And this slowdown is expected to continue for several months as we move into H2. So they're trading in line with budget at the moment, but it's going to slow down somewhat in H2. The business has responded rapidly to the market slowdown by implementing internal control to maintain the profits. That's currently, and I'm sure it will do so in the second half of the year. So in summary, really, what we've actually got is shortfall in profits from 2 areas. One is customer related, that's ATIC and SVS, and the other one is FAST, and that's due to short-term economic slowdown. At this stage, I'd just like to give you a quick update on Monmouth, and you'll be pleased to note it's not within that category. But we've had a significant impairment at the year end, as you well know. It's not trading in line with budget at the moment. It's got a very, very strong order book, and this is reflected across all their product portfolio, but more importantly towards the clean room sector, where we're seeing increased demand. And that's an easy win for us because it doesn't need a lot of labour to produce this product. They're experiencing operational challenges at the moment, and this is being handled by my good new friend Stephen as the Group Chief Operating Officer. But it's not all doom and gloom within the SDI Group. The group's enjoyed some strong performances from many of our portfolio businesses, in particular Applied Thermal Control, Astles Control Systems, Graticals, but also like to add Centec and also Synoptics. They've proved consistent and strong in their order intake and operational delivery, all reporting profits exceeding budget. It's not on my notes, but I'd like to expand it. A good example we've discussed throughout the days is Synoptics. So they haven't hit the revenue in line with budget, but their budgets, budgeted profits have exceeded their profits have actually exceeded budgeted profits due to the control of costs, and that's what we find across the group. These managing directors and directors of the businesses are very good at controlling their costs, so we don't see a lot of costs going outside budgeted levels. So if we'd like to move on to the next one, we've already mentioned this earlier on. This was the latest acquisition. This has been a target for us for many months. It's not a big acquisition, but it's very important to us. but it's had some complications in the acquisition process. And that's been delayed by 4 to 5 months. We hoped this would actually cross the line when the results went out. But we're at the final stages, but there was just some issues on the seller's front that they needed resolving. But now we're pleased that the acquisition process is complete, and we acquired that business in November 2023. As with most businesses, the founders will stay on board and run the business. What does Peak Sensors do? As you can actually see from there, it manufactures and develops temperature sensors, which are used in various industries, but mainly within glass, ceramics, and incinerators. So what we're actually doing is using temperature sensors in the incinerator, which is generating energy from waste. We've actually said it initially and in the last presentation about synergies, and it's nice to see one of our subsidiaries, ATC, is now sourcing product from Peak Sensors. And there are a number of other of our SDI business units that are actually interested in this product range. It's based in the middle of England, in Chesterfield. It employs 14 staff. The property you can see from the diagram below, it's a nice clean building within a nice industrial park. That is owned by the founder, Peter Smith, and he's leased the premises onto Peak Sensors. So if we move on to the growth drivers, that hasn't really changed, to tell you the truth, even with this difficult year we're having. Organic growth, 2023 organic growth has been impacted by destocking, which we'll foresee it's only a short-term issue, and also with the worldwide economic uncertainty, as you actually see from the news, that's impacted a number of our businesses. In the longer term, we still expect organic growth between 5 and 10%. And also SDI continues to look for synergies within the businesses, and we've started collaborations within the Lab Products Group, as I mentioned before about the sector side. So currently within the product group, there may be changes, but what we're looking at initially is the LTE Scientific, Safe Lab Systems, Monmouth, Applied Thermal Control, and Synoptics are joining that group. Why? It's because we've seen market overlap of customers, and that should provide strong opportunities for growth. They had a meeting this week. I think they've had 2 or 3 meetings now, and it's tried to get additional orders going in as a team at a quote stage instead of at the individual stage. A good example of that, as we mentioned in the annual report, is they're building a science park on Canary Wharf, and we're in the early stages of putting together a portfolio of products for that business. M&A, since February 2014, we've acquired 18 businesses. A number of these have merged into the existing business units. So what we've actually got is Attic. We've acquired 2 businesses, Opus Instruments and Quantum Scientific Imaging. That's incorporated into Attic. All the manufacturing now is in Lisbon for all those brands and products. And the other one is Applied Thermal Control and Thermal Exchange. Both chillers, both in the middle of England, one in Colville and the other one in Leicester. And we've combined the units in a place called Barrow upon Surrey, which is just outside Loughborough. And all the rest are operations autonomous business units. There's no change in our criteria, although we are more willing to use short-term earnouts to reconcile price expectations from sellers, as you can actually see very recently with Scientific Vacuum Services, where I think it was this week, was it how we paid out, or last week, the remaining part of the price consideration. The key constraints for us is the availability of target companies, but currently we've actually got quite a strong pipeline of acquisitions, which all 3 of us are looking into. So as we come to the conclusion of this presentation, summary and outlook, it's been a challenging year, as you can actually see from the numbers in comparison to previous years. We've had a few businesses that have not achieved budget, as discussed within the presentation, but really this is just a bump in the road for us, and I don't think it's going to affect our long-term plan. And I feel confident this is only a short-term issue, and it's why? Because when we actually came out of the strategy meeting a few weeks ago, we found that there's a large pipeline of prospective orders with a high probability of landing across the group. So we're sort of quite optimistic going forward. We still continue as a team to evaluate high-quality businesses as they become available. That's on the M&A side. Internally, we're still generating synergies within our business. You can actually see this through the presentation. and we continue to invest in our existing companies to drive organic growth. I think a good example of that over the years is Centec. Centec, we bought that making a profit of about £500,000, 4 times PBIT. We paid 2 million plus net assets, and for investment in that business, Paul Cook taking it on board as the managing director, we're looking at making nearly sort of £1 million profit. So it's a good business, good solid business, and this has happened within a few of our businesses. So really, despite the short-term headwinds, we look forward to the future with great confidence within this business. You know, I've been here sort of 10, 11, 12 years. Ken and I have discussed this many years. The business model hasn't changed. We say year in, year out, we still continue to drive growth organically and through M&A. Even with this short-term headwinds, we still have to operate driving the growth organically and through M&A. So hopefully, that concludes the meeting, and let's see what Q&A is coming across.
That's great, Mike, Amy, Stephen. Thank you very much indeed for updating investors. I will bring your cameras back up for the Q&A. But ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the team take a few moments to review your questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. Amy, I may just return to you to moderate through the Q&A, but firstly, thank you to everybody for your engagement, for those that pre-submitted questions, and for all your questions throughout the presentation today. Amy, if I could just ask you to read out the questions and then hand them out to the team for a response, and I'll pick up from you at the end.
Okay, so first question was pre-submitted. Does Stephen have any observations he would like to share after his first few months at SDI?
Absolutely. So currently I have the luxury to see the group with fresh eyes, and given my experience, I use the opportunity. The buy and build strategy has clearly been the bedrock of the group's current structure and success, but this is clearly only at the start of the group's growth curve. I've observed that the portfolio of businesses reasonably differ in their potentials, driven by the technologies, products and markets. I would expect that we will see different growth profiles of more as that clearly makes sense. I will be understanding more as I dive deeper into the potential of each of the individual businesses. So I'll be understanding the CAGRs and supporting long-term strategies. There are clearly many opportunities for each of the businesses to in product development, market share, diversification, and of course, global expansion, the US being, of course, one of those going forward. SDI's ability to continue acquisition growth clearly remains strong, and I hope now stronger. I would like to see more consistency in deals combined with robust group integration plans going forward. These plans need to be not only ensuring a robust autonomous business, as Mike's already said, but post-acquisition, we also potentially strengthen the existing group through synergistic opportunities.
Thank you.
Stephen, why did management take so long to buy stock after the share price fall earlier this year?
Let me answer that one. Okay, so we're all willing to buy stock, but we're in a closed period. The closed period lasted 4 to 5 months. So first of all, we had a closed period with the annual report, but this deal with Peak Sensors has just dragged on. So the advice of FinCap is to say you can't buy any stock, and that was the main reason why. Otherwise, we would have bought stock earlier. So and we did actually buy stock, a few weeks ago.
Okay. What confidence can you give us that Monmouth and Attic are through the worst now?
Yeah, I can take that. I think optimistically that we can really see the light in the tunnel. As Mike talked to with Attic, it's very much a short-term issue where order coverage from its biggest customer was delayed due to destocking, and that's commonly across the public domain. We've now received order coverage for that, so that risk is now gone. But really, we're seeing the downturn in the figures driven by purely timing. Going forward, we're looking to make that business a lot more robust. So we're currently looking to reduce the dependence on a single customer, and we're looking within the same industry to diversify it and take on other customers within that industry. Secondly, we're also looking at a different industry as well, as Mike alluded to earlier. We're looking at the professional astronomy industry as well. In the coming months, we're expecting a strong order from that, which was the first major one demonstrating our technology. Our technology is equally as applicable to those as the life science market as well. So really, the answer to that question is to ensure robustness across that business. Now turning to Monmouth. Monmouth is seeing a very strong order intake at the moment. This month it was a very strong month, and our visibility going forward remains extremely strong. And I think that this is really important because the optimism within that business is growing. There remains challenges from the operational side of the business, and we are working with the management of Monmouth to resolve that, to unlock that. But really looking at the order coverage and because we really understand what the issue with the operational side of the business really is, all we can see is very much is an optimistic rest of the year into next year.
Okay, thank you, Steve. Could you provide, Mike, can you provide insights into SDI's strategy for creating recurring revenue streams within either of the company's two segments, whether through M&A or by exploring new lines of business?
What we do, so recurring revenue streams from the business is between 15 and 20%. That is mainly through servicing. So we've got a good service revenue stream at LTE, at ATC, at SafeLab, and also at Monmouth. With Monmouth, now we've actually got Stephen on board. We're actually looking at improving that service. It's not as high as we would like there. Also, we've actually got some consumer side of the business as well, which is Centex Sensors. Also, I forgot to actually mention about Astor's control systems. 50% of their revenue stream is service and support of their dosing machines. Is there anything else we can think about? I think that's it, really. It's the main ones. But it's good to have. It's nice to have that recurring revenue stream. Many years ago, it wasn't. It was just CapEx. But now we can actually see that growing. And I'm sure it's going to improve as we grow the business.
Okay. Has it been considered to hold off new acquisitions and pay off existing debt in that high interest environment? But I think Mike's already answered this. So I think Mike's already stated that we will continue to look for acquisitions because that's part of the business model of this company, that the strategy is unchanged. We will continue to pay off existing debt in the high interest environment anyway. We are focusing on our working capital. I think that's kind of what that is telling you, that we will be trying to generate more cash from our working capital in the next 6 months. And, we are continually trying to pay off our existing debt. That process is ongoing for us. There's another question here from Terence. Can you please inform us of the current gross and net debt excluding leases? Well, the net debt excluding leases is 13.2 million at the end of October, as I mentioned in my presentation. The value of leases is about 6.7 million on balance sheet, so you can add 6.7 million to that to get the gross figure.
But this is including the leases on property, isn't it? They've got the standards.
That's right.
Yeah.
Leases is an accounting where they gross up the leases, and the other side of it is usually fixed assets. So it's your assets on your balance sheet. So it's, the banks exclude this normally from a definition of net debt. That's why we quote that particular metric rather than any other. All right. It seems that acquisitions now come with lower margins and a more expensive multiple versus some years ago. What are the reasons for this? Deal size, more competition on deals, focus on growth versus return on invested capital?
I don't think so.
I'm not sure that's true, actually.
No, I think when we do an acquisition, it goes out to say this is the total consideration. And in recent acquisitions, we bought the property. But if you just purely look at the goodwill element of it, we're still within that 4 to 6 parameter, which we've always said. So it all depends on what the net assets are. If your net assets is only 400,000, which is sort of working capital, it's a low multiple. But if you're adding on with fast 1.6 million of property, it does increase the multiple. That's why I like to separate the goodwill element from the net asset element, because it does skew it somewhat. But we all stick to this principle. Well, we have always stuck to the principle of 4 to 6, but I think 3.5 is the lowest we pay for an acquisition.
Okay. So this one's asked twice. How is it possible on the 29th of September that you gave a higher guidance for FY24 when there was only 1 month left for H1 to close? And this is, it's around ASIC, isn't it?
It's all around ASIC.
Yeah. Do you want to talk about
Yeah, I'll talk about this. Yeah, it was quite frustrating because this has been dragging on for a period of time. We knew this order was going to come through. We've got the goods in stock, the finished goods in stock. We have all the components, the sensor components. What actually happened with ASIC, with the customer is they moved the procurement from the base in Singapore to a centralised base in the Netherlands, and they decided to actually reduce their exposure from 3 months to 1 month, and it dragged on for months. We thought we could have a good shipment going out the door, even if it was the last month of the year. We thought we could hold off, but sadly it didn't. So it gave us a big hole in the H1 figures, and all it's done is moved it to the right. The other two of 200,000 of each with FAST and SVS respectively, that's small compared to ATIC. ATIC was just too big a hole for us, so we had to hold our hands up saying, look, this is not coming through in H1, and it was just last minute, which is a shame, really. It's sad for me.
This one for you, Mike. Have you changed your approach to M&A in view of the tougher outlook? Are valuations expectations adjusting? And what is your view on the increasing debt at this point in the cycle? I'll probably do that the last one, but you can.
No, I can do it all the time.
Okay, yeah, sure.
Yeah, it hasn't changed. The model hasn't changed. We're still looking at the multiples. At the moment, we've got 3 of us looking at it now. We talk heavily about the acquisitions. They're all ranging between $500,000 and $1 million. Peak Sensors is actually lower than that. It's only sort of generated sort of £400,000 worth of profit, but a good business. How we fund them going forward, that's what we're discussing at the board at the moment. And because at the end of the day, I think our multiple on debt is about 1.1.
Yeah,
something like that.
Yeah.
Do we actually increase that? Shares? We don't know, but it's not going to stop us doing M&A. So that's what we need to discuss going forward as a board. You got anything to add to that?
Nothing. Stephen, one for you. Can you please provide detail on the plan to boost organic growth?
Absolutely. To look at that, really, we need to look at individual business level because the drivers are quite unique to each business. A common denominator across the group seems to be very much looking at geographic expansion and taking a number of the businesses into new geographic markets. For example, the US, and that seems to be a fairly low-hanging fruit across the board. So really, it's looking at first of all categorizing the businesses across the group as the stable businesses and also the higher growth businesses. And really, the higher growth businesses developing a strategy of how they're going to grow. So as I say, it's not only it's going to be geographic markets probably initially, but also looking at product development, looking at approvals, and really looking at how to diversify into those markets. So so there is a journey ahead, but it's really focused on the characteristic and characterization of the business.
Okay, a question for me. Someone's asked, am I correct in hearing the segments will be rebalanced? If Sensors and Control segment is too large, why not simply break the segment into 2 and report 3 segments in total? By reclassifying, you prevent the reported segment organic growth numbers from being validated. But first of all, I think we explained that we are resegmenting. We had a good close look at this because clearly the reason behind this is that the site scale is too large. But do we keep digital imaging going as a division, or do we what would the future look like? Well, first of all, we have a bunch of lab products businesses that we can see synergies with, and it's really helpful to have them all within the same division. There'll be 1 or 2 more within it, but that seems the most sensible approach given our future strategy. So it's not really trying to, obscure previous data, because we will provide, before and after data at the current year end. But the idea really is more to support the business going forward, and it just seems more appropriate for us. I don't know if you have anything to add, really.
Yeah, it was just to say we're not shoehorning these businesses into lab products. They're actually talking, and they think they can work together. So it makes perfect sense to put that into the group. So I think that started the exercise going forward, and then we actually looked at it and saying, what should we do with the rest of them? It could be in time, you could be right to say we should have sort of 3 segments, but currently it's going to be 2. And we may move it out, but I think initially the lab group works, and that's what we've agreed. So that's how we're running at the moment. We've got meetings, as I said to you before, about it, and it's the rest of the businesses. How do we bring those into a meaningful segment? If you look at it historically, as I said to you before, we've only got 3 businesses in the digital imaging, which is Attic Cameras, Synoptics, and Graticals. Well, really, Graticals is chemical etching. It's not digital imaging. We just put it in there. So what we need to do is to have a better look at our businesses and to put them in the correct segments, and that's what we intend to do.
Of your M&A pipeline, how many do you expect to execute in 2024? And will this take you on to a gross debt level, and will you remain comfortably covenant compliant? Well, to answer that question, we'll always remain covenant compliant because we have to. So whatever we choose to do, it will. And in terms of how many we expect to execute,
we never put a number on it.
We never put a number on it because it's just not a sensible thing to do, simply because you don't really want to be forced into doing a number just for the sake of doing a number.
Correct.
It should be the right deal at the right price, and often the process itself takes a while longer than you think it will do usually.
Well, Pete is a classic example of a small business.
It will. So there's any number of reasons why I can't put a number on it, really. In terms of M&A, what do you think differentiates you from other competitors such as Judges or Halma? Are you seeing a clear trend of higher prices paid? It may seem strange in an economic situation like the current one, but the prices should be lower. No, I agree with you, prices should be lower. So I can agree with you on that.
So, mate,
but
they're not.
Are we seeing any different, what differentiates us? We don't tend to compete with any of those, do we?
We get them in early stages. So if you have a look at it, we've got one in the books which has been around for sort of 3 years. We're still talking to them when the time is right. And then you look at Fast, we turn that round in sort of 3 months. So there's no sort of time limit. It's just talking to people, talking to businesses, and if they're interested in come across. But also, very few people like Judges, Halma, etc., are looking to buy businesses within the profit range of sort of 500 to £1 million. It's just outside private equity as well. So they're good businesses for us.
What expectations should we have for long-term gross margins? And what do you see the business in 10 years? And what is the competitive environment like for the companies you own? Well, I'll answer the first one about long-term gross margins. I mean, I still see north of 60% for gross margins. I mean, obviously, mix plays a part with the M&A that we buy. So you do find some of the acquisitions we make, the gross margins are below our 60% on materials. But that gives us opportunity, as we've seen on Monmouth. Actually, I don't think we mentioned that. We're working to improve their gross margins, and we've had some success in there. And we will look to do that elsewhere too. And so that's answers that one. So where do you see the business in 5 to 10 years? I wish I knew. But much larger, I think, is the answer. With our strategy, and we continue our strategy as we've articulated it today, then it should be decidedly bigger.
But what we do know is each of the businesses is going to be quite individual, and the growth of each business is going to be very different. There are some higher growth businesses within the group, and they're going to be considerably larger and look very different to what they do right now. But some of the businesses will look very similar to where they are right now. So it really depends. What we do know is all the businesses will be still autonomous.
The competitive environment, I don't know if that's truly changed a great deal, is it? So what's the competitive environment? Is it tougher?
Not really. I think we've acquired 18 businesses. We've only been in competition with 2 of the businesses. That's one is Shell and the other one was Fast, but that's when they use corporate people to sell the business. But then it wasn't a bidding process at all because we stick to our valuations. But they like how we work, and that is autonomous business units. We're not the type of business who we've seen on many occasions who'll buy the business and then after 12 months saying we don't change it. But then they put hobnail boots on and put SAP or JD Edwards in place, and you're filling boxes in, and that's not what we do. So we like to run them as autonomous units, but what's coming through now, as I say, is synergies. These businesses are talking to each other.
Okay, I'll answer this. How much do you anticipate Peak Sensors revenue to contribute towards the overall revenue of the group? Approximately for the first year, to be around £1 million or so. For a annualized basis, probably between 2 and 2.5. Mike, when you're acquiring companies with property assets, how do you think about return on investment? Do you intend to sell these assets? If so, typically, how long does this take?
I think we've talked about this before. I think the only return on assets, I think we mentioned this about the property. So we've got about £5 million worth of property on the books. Usually you're only getting between 6, 7, 8% yield on it, or we're getting, what a return was 15% on a business. So we are actually talking as a board to say, should we actually move those properties on, do a sale and lease back? But then in this market, you've got 7.5% interest. Is it worth doing it? So it's a discussion point, to tell you the truth, at this moment in time.
Okay. Can be that the companies acquired during COVID were inflated on revenues, so SDI Group has overpaid and the acquisitions are not creating the expected value. Well, there's only one. We do an impairment test every year anyway, so this one does come out really if they're not creating value. We've had one, Monmouth, probably. I was suggesting that was right in the heart of COVID.
That was.
So we've done the adjustment. I think we spoke about this at length really at year end.
Yeah, I can repeat it. I think one area we're never going to avoid, and that's that IFRS 16. I think it's 16 on the leasing. With that was nothing to do with COVID. That was just interest rates and property valuations. But the rest of it, the 2.5 million, we did a 3-year average of that business. And what actually happened is nobody realised that COVID would just drop off a cliff. So everybody shut the doors and nothing came through. But the order book was still strong. But then we had an operational logistic issue whereby instead of people buying between 5 and 10, 15 of these biological safety cabinets, they're only buying 2 or 3. So we didn't have a service department to actually service support and deliver the products. So with Stephen on board, that's what we're trying to do now. The biggest problem is, for us really, as soon as you actually jump and make that impairment, then you can't actually reverse it. So Amy and I were discussing about this. It looks really quite healthy going forward. Monmouth looks a good business, but it just happened to be for that period of time, it didn't actually deliver in line with expectations. So therefore, we had to take that hit.
Okay, running short on time, I think. What are your plans to return digital imaging segment to profitability? Do you count on the increase in volumes or optimised cost structures? Well, digital imaging really has in terms of scale. And first of all, it's still a profitable division. Both all the companies within it will be profitable for this financial, just to be clear. Do you count on increasing volumes? Well, I think we've talked about it. First of all, it has order coverage.
Yeah, we've already addressed it. And it's really that's focused purely on medic and what we've done to improve the robustness of that business really ultimately addresses that.
Have there been or are there any plan to do further write-downs of intangibles? No, we don't plan to do this. Usually it is something that it's an annual calculation that we have to do. And as I've explained to some investors when they ask me this question, it depends on the circumstances around the individual business at the time that we do the calculation, which is usually in the summer. The interest rate environment influences our weighted average cost of capital, which then influences the calculations. It's a really tough one to answer.
Lots of variables, isn't there?
There's lots of variables in this calculation. At the minute that we've done a write down on Monmouth. The other one where we had a bit of less headroom was on Fast. But beyond that, we're reasonably good shape. But it does depend very much on circumstances at the time we do the calculation. So in short, there's no certainly no planned ones, but we redo the calculations annually. So I think we're coming close to.
Perfect. I mean, as we say, we're coming up to the hour anyway, and for every question that you do seem to ask, there seems to be another one coming. So I guess we could take another hour or so of your time. But if I may just say thank you to everybody for your engagement. All these questions, Amy will make available to you post the meeting. So if there's anything we haven't covered off in the presentation or through the Q&A, we can add an additional response and publish those if it's appropriate, of course, to do so. I know investor feedback will be particularly important to you all, and I'll shortly redirect those on the call to give you their thoughts and their expectations via feedback. But I wonder before doing so, Mike, if maybe I could just return to you just for a couple of closing comments, brief comments, and then I'll redirect investors to give you their feedback.
Yeah, this has so far been a challenging year compared to previous years. I've said before, we've got a few businesses that are not cheap budget. I think mainly is Attic really. It's a shame that it took so long for this all to come in. This is just a bump in the road for us, and I don't think it's going to affect our long-term plan going forward. We're still going to create or drive organic growth within our existing businesses, and also we're going to do M&A. So for us, I think, especially in the short term, we're looking at a large pipeline of prospective orders for the high probability of landing across the group. I just think this is a short-term sort of blip for us, really.
That's great. Mike, Amy, Stephen, thank you very much indeed for updating investors. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of SDI Group PLC, I would like to thank you for attending today's presentation, and good afternoon to you all.